Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Indranil Pan, Chief Economist at Yes Bank, joining in. Welcome to the show, Mr. Pan, and always a pleasure to speak to you and get insights from you. Mr. Pan, let's start off with what's the overall outlook that you have if you have to look at calendar year 22, that we are on the first day of the year in terms of a working day.
Well, unfortunately, my job determines that I do a lot of crystal ball gazing and look at and possibly give you the best answers for 22. However, very honestly, I think this has become one of the most challenging tasks ever. If I actually look back at some of the projections that me and my colleagues had put out in 2021, thinking that they had taken the most robust of assumptions, I think are significantly questionable. For 2022, I think uncertainties don't die down at all compared to 2021. Challenges possibly are much more intense because this is a phase when the globe, as well as in India, we are looking at how we can come out of the pandemic induced easiness in terms of both the fiscal policy and the monetary policy. On the fiscal policy, I think it needs to be realized that the world is struggling with high debt levels. To that extent, inflation may be good, but from the political angle, inflation will be bad. So there is a lot that the monetary policy authorities globally also needs to do in terms of withdrawing from the monetary policy in the face of the fact that fiscal policy also needs to tighten. So the challenges of growth could once again be emerging strongly along with the COVID and the Omicron related sort of disruptions that it is causing through the world. And therefore 2022 would be no less uncertain than it was in 2021. Closer home, I think the point that I need to make about India is that we have been sort of significantly focused on investments and investments as being the next driver of growth. In my mind, I think there is a bit of a question mark regarding that, simply because you can't expect private investments to happen when overall capacity utilization is about 60 to 65%. You can't expect private investments to happen even with low interest rates. And that could be the challenge. And I think to a certain extent, some of these needs to be addressed within the union budget FY22 for the next sort of trajectory for growth for India to be set up.
Right. So with all of this, what's your expectation in terms of growth for the year?
But for the current year, we are at a 9.3%, which is slightly lower than the 9.5%. However, that 9.3% doesn't immediately take into consideration the Omicron-related disruptions that might be caused during the fourth quarter. And also not only domestically, but also in terms of the logistics and the trade relations and global growth induced to sort of pick up in exports from India could all be at risk. For the next year, I think we have not really done the numbers yet in a very sort of hard and fast way. But my sense is that growth would be maybe closer to a 6.5 to a 7% level compared to RBI's expectation of close to a 7.5%. And a lot of my colleagues are also expecting 7.5 upwards. I think we have to be slightly careful in terms of how growth numbers are provided, in the sense that the one of the bigger issues is, yes, job growth may be happening, but what is the level of wages at which job growth is happening? If I really look at the rural wages, there is some amount of positivity in terms of the nominal levels, but in terms of the real levels, I think it is still negative. So a lot of these factors, as I said, there is a lot of uncertainty going forward, and a lot of these factors needs to be needs to unveil itself over the year for the growth trajectory to pan out.
Right. And with this, in the latest RBI meet as well, clearly they've continued to maintain their stance. How do you see that position changing? Because central banks across are looking at squeezing liquidity. How do you see the RBI reacting to it, one? And two, by when do you see the trajectory with regards to increasing rates?
I think the RBI is struggling with a lot of uncertainties. Now, my own thought process with this regards is that the RBI will possibly have to wait and see the fiscal policy first in terms of determining what it wants to do with respect to the monetary policy. I think the point number one, therefore, is that if the fiscal policy tends to be relatively on the tighter side, then the RBI possibly doesn't have a chance to take away a monetary policy accommodation in a very significant way, because you can't really pull out both the engines that were firing or that were supposed to be supporting growth in the short to medium term. So that's point number one. Therefore, I think the RBI would be relatively, and given all the talk that the MPC members have come out with, even with respect to the dissenter on the MPC, he's never talking about reversing the rate cycle. He's talking about taking away, or his vote is against, or his dissent is against the stance of the monetary policy, where he's clearly saying that I want the stance to be neutral simply because it gives the flexibility for the RBI to move either ways. He's also not talking about any change in the rate. So my perspective is that so long and so forth, inflation remains within the broad 5% average level, what the RBI is also signaling to us for Q1 and Q2 of the next financial year. They possibly don't move on the rates immediately, because it might actually entail a significant amount of risk for the growth process. Therefore, broadly, I would be looking at, say, a minimum of 1 and a maximum of 2 repo rate increases. I'm not talking about reverse repo, because that's a different ball game. And even if reverse repo is adjusted, we all know that the VRR rates today, or the operating rate, is more closer to the signaling rate. In terms of repo, I think I'm looking at a minimum 1 and a maximum of 2 rate increases. But the first one will be as much pushed back as possible, and the gap between the first and the second will be as wide as possible. So I think let's keep it at that only.
Right. And overall, how important is inflation going to be? Because again, that's a concern globally. We would probably face it as well. How do you see, at what priority will the government look at inflation versus growth?
Number one, I think, again, going back to the MPC and looking at all that have emerged in the press conference post the monetary policy, one of the members of the MPC clearly is of the opinion that it might actually take multiple years for the negative output gap to close. So in terms of inflation, in my personal feeling is that if I want to link inflation to the RBI's reaction function, I think that is relatively lesser important to the RBI today than closing the negative output gap. So that's the reason I say that that given that the RBI is targeting a 5% and it is not crossing the 6%, in the new atmosphere that we have, possibly the RBI could be looking through the relatively higher inflation at this point in time, given as assuming that demand drivers to the inflation has yet not kicked in. So if the demand drivers kick in, then the RBI's reaction function can change. But given that the negative output gap is likely to be persistent and demand drivers are weak, I don't think the RBI therefore has much to do in terms of inflation right now. Their focus would be more on the growth than inflation.
Right. And overall, if you see in terms of the current account deficit as well, Q2, we were at around 1.3% of the GDP. There has been a widening trade deficit due to higher oil prices, higher gold and non-oil as well as non-gold imports amid the domestic recovery. And that's been one of the primary causes of the CAD. Now, taking that into consideration, how are you expecting, the rupee to move as well? Do you see higher depreciation basis the widening CAD?
The depreciation of the rupee, very honestly, we do look at the CAD, but I think it is more to do with the overall demand and supply of dollars. And therefore, logically, we should look at the balance of payments rather than just focusing on the CAD. Now, in terms of our expectations for the next year, we still have a small wafer thin positivity in terms of the balance of payments. simply because we are expecting investment flows into India to continue through both the FDI, and we are hoping very intensely on the bond inclusion. So if the bond inclusion happens, then that could also lend some positivity in terms of the FPI debt inflows. And these are the two most critical factors that we are looking at to pad up the capital flows sufficient enough to cover up for the higher current account deficits that anyways are emerging. Yes, current account deficit is on a weaker footing. For the current year, we are expecting a negative 1.6 to 1.7 after the positive current account balances that we saw for the last financial year. Having said that, however, for FY23, we are expecting more or less similar levels of, say, about 1.7% of GDP, the current account balance, because of not much more sort of upside that we see in terms of the oil prices, given that growth globally is likely to normalize.
Right. And overall, if you talk about the balance of payment side as well, simultaneously, especially in terms of the fiscal deficit, we're at around 46.2% of the budget estimate during April to November, as compared to 135% a year ago. Now, what is the reason that we've seen a contained fiscal deficit? That's number one. And how do you see it moving year on?
So from the fiscal perspective, I think the tax collections have been much more robust than in the previous financial year. In fact, tax collections have relatively surprised on the higher side, even for the current financial year when compared to the budget. So that's the positive side of the fiscal. And very honestly, I think to a certain extent, inflation is helping in this matter because most of India's taxes are ad valorem. And therefore, a higher inflation means a higher nominal income and hence a higher tax collection. On the other hand, I think expenditures to a certain extent had been lagging. But we'll have to watch out for the Q4 expenditures because from a government's perspective, as they go into the budget and ahead of some of the critical elections in some states, they would want to fire the expenditure channel. So some of the positivity that we see in terms of the fiscal might actually close down. And therefore, we are expecting fiscal to be broadly in the 7% as a portion of GDP compared to the 6.8% that we had been talking about.
Right. Yeah, go on.
No, please go ahead.
Yeah, and with this, especially on the divestment target, do you think that we are significantly behind, even if you're assuming a LIC divestment? Are you seeing a shortfall against a target of that 1750 billion?
Yes, no doubt about it. But if you look at it from with another lens, I think the shortfall in the LIC for this year will be a positive for the next year when they actually will manage the LIC. And even though they may miss the target for LIC divestments till the 31st of March by a small margin, it will definitely come through in the next year. And that is a huge positive for the fiscal numbers for the next year, which will at least optically enable the market to be relatively positive on the fiscal and therefore how overall interest rates move. The other factor is in terms of the asset monetization plan that the government has had. Even after having announced the asset monetization plan and a target of 88,000 crores for the current year, I'm not sure whether we have heard much in terms of the asset monetization and how much it is likely to be successful for the current financial year. So one of the critical strategies for the next fiscal, which should actually come out very clearly in the budget document, is a clear plan as to how they want to achieve the asset monetization plans for the next year, assuming that they miss the targets for the current year. So that I think forms another very crucial peg in terms of the asset monetization that we are looking at. Now note that one of the critical factors that have padded up fiscal, which is basically the RBI dividends, may not be as strong in future years as it has been for the last 2 years, simply because we are once again on an interest rate upcycle. And that to a certain extent will reduce the amount of profits that the RBI can be expected to generate out of domestic operations.
Right. And very lastly, overall, Mr. Pan, in terms of where GSEC borrowings go, the cash balance seems comfortable. We've seen a T-bill borrowing of around 3.34 trillion in the fourth quarter of FY22 is what we're looking at. Do you anticipate any additional borrowing, or do you think we are pretty comfortable with this?
Yeah, for the current year, I don't anticipate an additional borrowing because I think even the small savings collection, apart from the comfort on the cash balances that you just talked about, that is likely to sustain and is definitely a positive in terms of bridging the fiscal gap or the additional fiscal gap that emerges. So I don't expect a higher borrowing number for this year. We are still doing our numbers for the next year, but broadly, the sense that I get is that probably the government would be targeting a 6.5% GDP number, fiscal deficit as a proportion of GDP, which at the margin could actually mean a slightly lower gross borrowing numbers for the next year compared to this year. So that in itself, in my opinion, could actually provide a bit of a comfort in terms of how you look at the 10-year. But having said that, obviously, I've clearly pointed out that we are expecting some interest rate moderation or a modification on the higher side from the Reserve Bank of India, which to a certain extent would push up the short end of the curve. And therefore, the government securities yield curve is likely to be even more flatter in the next financial year than in the current financial year.
Right. And then do you see any impact in terms of yields? What's your view? How do you expect yields to move in the near term?
Yeah, so given that we are looking at, so if I assume 2 rate increases for the next financial year, I'm still pretty much sure that that the 10-year might actually close within the 645 sort of a level and doesn't really cross the 650 in the current financial year as was feared by the market, simply because there is no additional borrowing from the central government. And 2, going forward, the expectations that tend to form is for a lower inflation. Now, if I were to take the RBI's inflation target in mind, you anyways have a lower inflation in Q1 and Q2 of the next financial year compared to the Q4 of the current financial year, which is a positive for the bond markets. Secondly, I did say that my broad expectations at this point in time is for a relatively lower gross borrowing number for the next financial year than this financial year. So I would still be hoping that with the 2 increases on the repo rate that I talked about, we would still be at around 675 by end March 2023, compared to an end level of, say, a 645 by end March 2022.
Right. So that's overall with regards to what the economy would look like. Thank you, Mr. Pan, so much for joining us on the show. Always a pleasure to get insights from you. Thank you. Stay safe and speak to you soon again.
Thank you very much. Thanks.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.